Okay, so we may have some more people jump on, and that's great. Thank you, everyone, for coming. I'm really pleased to see all of the new faces that we have here. For those of you that aren't aware, that have been here with us for a while, I was on that podcast with Whitney Sewell and got a number of contacts from people, and those are most of the new faces. I talked to them, and it's really exciting because a lot of these people that are joining us have the same philosophy we do, and are thinking about the same stuff we are, and trying to get to the same place that we're trying to get to. So I think it's really going to add a lot to have some new faces and some new people to talk to. And so I know it's hard on Zoom, and we'll figure out exactly how we want to do this. But I'd like to have people still network and contact each other, and that might take some time. But if we do these meetings and everyone shows up, we'll get to know each other a little bit. And we have diversity from all over the country now. So I'm really excited, and I thank you for coming. One thing before we get started, I just wanted to kind of remind people, or especially for those new people, just that the mission of our group is to build a community of like-minded investors, people that are interested in creating financial freedom by passively investing in real assets that generate real cash flow. That's what this group is all about, and that's what we're working to help each other do. So we're going to work together to educate each other, network, talk about deals. We're going to have sponsors like we do today that'll come on and talk about what they do, and hopefully we'll build a community that can help us all reach that goal of financial freedom. So that's kind of where we're going, and that's what we want to do. So Left Field Investors is our new name. This is our second meeting with that name, and the reason why we decided we need to do some branding was because as we're going to sponsors like Drew and saying, hey, Drew, we got this group, we might have a few investors for you, and it's just confusing. So now we have Left Field Investors. We can just say, when you're talking to a sponsor, you can say, hey, I'm part of Left Field Investors, and hopefully that'll give us some traction with different sponsors. The name, it came from, I'm a former financial advisor, and I think when the advising community thinks of what we do, these alternative investments, which is a term that, I really don't like because they're not alternative. They're the, everyday, where you live, what you do kind of stuff. But, the financial advisors or Wall Street looks at us like we're out in left field. And so that's where we came up with the name. I do want to briefly introduce kind of the team that put this all together and thank them for being here. The founders, these are the four that started this with me. And we've worked on some of the tools and the website. We've been doing a lot of work. Sean Donnelly, Steve Sue, and in the bath or not in the bath, but at bath time is Mike Rodriguez. So thank you guys. And then after we started this, there were a couple of guys who were super interested and had a lot to add. So we added Chad Ackerman and Ryan Stieg as contributors. So that's kind of the leadership team. You can reach out to any of us and with questions, or if you have ideas for the group. I really would encourage anybody who has, ideas, constructive criticism, the ways that we can make this group better. Like I've always said with this group and another group that I run, I'm not a professional, group guy. I'm just kind of, the analogy I've been using is we're flying a plane and we're going to figure out how to land it while we're flying it and kind of build the landing gear as we go. So I don't know what this group is going to become. It's already become something that is a little bit beyond what I had imagined in a good way. So I'm super excited. So thank you all for being here. At this point, I'm going to toss it over to Sean, who's going to introduce our guest speakers. And just so everybody knows, we typically, we cut it off at an hour. So if we have time at the end, we will do kind of just brief intros on a couple people. I'm going to try to do that every meeting, to have a couple people say, hey, here's who I am, so we can kind of get to know each other a little bit. But we're going to toss it over to Sean, and then we'll take it back from there. Thanks, Sean.
Cool. Thanks, Jim. Well, I've got the pleasure to introduce brothers Drew and Neil Wahlgren to our group this evening. Drew is the director of capital markets at MAG and joined in 2019. And prior to that, he spent a number of years at Liberty Mutual Insurance. He holds a BS in finance from Cal State University Hayward and lives in San Francisco with his family. When he's not talking to MAG Capital investors, he's spending time with his son and his daughter, as well as hiking and woodworking. His brother Neil is a COO and also joined MAG in 2019. And prior to MAG, he was a COO of another Bay Area private equity real estate investment firm. And maybe more importantly, prior to that role, Neil was a pilot with the United States Air Force and Navy, logging over 2,500 flight hours in the Iraq and Afghanistan wars. So before we go any further, Neil, thank you very much for your service.
Yeah, absolutely.
As well as being an Air Force Academy graduate, he holds an MBA from Texas A&M and an MS from Troy University. He also lives in San Francisco, and when he's not spending time with his son, he is sailing and, of course, flying. I've had the pleasure of getting to know Drew over the last several months, probably since COVID started, when I jumped in and got into one of MAG's investments. I know there's a few other people on this call that are also in with MAG, and it's just a real privilege to have both Neil and Drew on this call, because I really like the MAG investments. I like their model. So I'm hoping that they can not only share a little bit about MAG and the structure, but maybe look into their crystal ball a little bit and tell us about what they see in the passive investing landscape going forward. So with that, I'll turn it over to you, Drew, or Neil, whoever's going to go first.
Yeah. No, I'll be sort of presenting, and maybe I can share my screen and present some slides here that I put together. If not, that's fine too. And Neil isn't able to join on video, but he's certainly going to be commenting here with me. But is there a way I can share my screen, or? Oh,
yeah, I just unlocked it. Try it out and see if you can see if it works.
Let's try this. Let me know when you can see my screen. We'll try to go full screen here.
Yeah, we got it. Perfect.
Beautiful. Well, you got our intros, but now you get a couple pictures of us in case you didn't see Neil here. As you can see, we look slightly like brothers. We might share one parent, so I'll get right past that. We're basically heading up the capital markets team of MAG Capital Partners. We're really a boutique investment shop in commercial real estate, and have this focus of single tenant industrial properties with absolute net leases. It's really our niche. We like keeping in that lane. We do some development opportunities as well, but frequently we're really keeping in that industrial lane. And we'll talk more about why that is in a little bit. So Neil's really, as COO, pulling all the pieces together, and but him and I are really kind of heading up that capital market side, working with lenders, investors, like all of yourselves who have questions and may be interested in investing passively in these properties that we acquire. So the principals aren't on here, but Andrew G. and Dax Mitchell are the two principals. And as you can see here, they have a long time history, a long record of experience, really. Dax is a founding principal, had a long 25-year commercial brokerage history. So he's really that guy that has a lot of relationships in the industry. And Andrew G. came from a commercial appraisal background for a long time. So he's very much the sort of underwriting guru and the valuation experts. We currently holding $250 million in assets under management right now. It's a little over 2 million square feet of property. So been at this for a while. Officially, MAG Capital Partners was formed in 2015 once Dax Mitchell partnered with Andrew G. And we've been going pretty hard, pretty strongly focused on this niche that I mentioned here a second ago. I'm just going to go through a little bit of kind of what we do, and then we'll kind of start talking about, why we focus on these properties and what our strategy is. But as you can see, stabilized acquisitions here, this is really the majority of what we do. It's sale leasebacks, which we'll talk about, but it's really stabilized properties with single tenants and net leases. So very much a stabilized opportunity. So we're not looking at a lot of value add kind of opportunities. This is, like I said, the majority of what we do. However, there are some repositionings and some development opportunities that we do seize on. And those are, opportunity based. So like I said, a smaller portion of what we do. But generally these stabilized acquisitions, we're talking about 3 to 10 year holds, annual rent escalations, usually some renewals on options on those leases as well. So, we're coming into a property, setting up a new 15 to 20 year lease. And of course, those options are on top of that. So not really long-term holds, but it really depends on kind of case to case. Are we talking about a 3 to 4 year hold in one situation, and maybe another opportunity we're looking at maybe 5 to 7 years? And Neil, you can chime in whenever, but I'm going to throw it to you in just a second.
Sure, absolutely.
So industrial real estate, right? This has been, it's been strong for a while, but this year has really thrown a big spotlight on this asset class. It's a little bit more boring. I think a lot of people really like looking into multifamily. It's certainly for a long time was sort of considered, in 2010, for instance, was sort of considered the recession-proof asset class. So, COVID's just a whole different animal, and I think it's really exposed some weaknesses and strengths in different markets. But industrial has certainly shown its strength throughout COVID, as we see a lot of essential businesses, obviously, like food and beverage, continue to operate. Third-party logistics companies continue to fuel the demand here to basically negotiate all the logistics involved with these industries. And of course, the big thing everyone's thinking about is e-commerce, right? Everyone's shopping on Amazon or wherever else online. And so there's a continued or an increased demand for more logistics and a higher level of inventory. We've talked to a lot of folks that are, they're saying their customers are demanding a higher level of inventory because they don't want to run into supply chain issues due to COVID-19 or whatever else it might be now. So people are running a little less lean, knowing that there's some, there's probably a lot of companies who lost a lot of revenue due to lack of inventory after people started running out of products due to COVID-19. Do you want to talk a little bit about that too, Neil, about kind of the strength in industrial right now?
Yeah, certainly. Thanks, Drew. From a firm and from, I'll speak a little bit more on the acquisition side. So working hand in hand with the principal, Dax Mitchell, what we're seeing really over the last 10 months on a relative basis compared to other asset classes, we've seen industrial really kind of stand out as the new star, and not really because it's doing anything that it wasn't before, but just that it's maintained an exceptional level of consistency. And you can see on the chart there that the vacancies and delinquencies from tenants sitting at about just shy of 2% across the industrial class compared to almost 25% with multifamily there. And that's representative in what we've seen even with our portfolio. Across, when COVID hit, we made the decision to, monitor our distributions, but really all but one of our tenants continued to pay. And that was across about 24 separate projects that we owned pre-COVID. And really, working with each of those tenants, a lot of them, exceptional amount of them were able to be classified as quote unquote essential industries, especially in the Midwest states where some of the restrictions were a little less extreme than some of the coastal ones. And that's where a lot of manufacturing's based, a lot of distribution hubs are based, and a lot of those core industrial assets, frankly, that we pursue, but are there geographically as well within the U.S. And what we're able to see is these companies, a lot of times they trim down their office staff a little bit, but in terms of the operations, in terms of revenue, and in terms of, more importantly, paying rent, we just saw a huge amount of consistency across the board there. So I think that's kind of the underlying reasons of why this graph that you're seeing there exists, and to echo what Drew's point was there.
Yeah, this was, the first industrial sale leaseback we did was in 2015. And, in 2015, 2016, the principals here that said to me many times ago, yeah, we were expecting a downturn in the economy around then. And, bull market gets a little long in the tooth, as they say, and hey, we got to start planning for some kind of recession. So obviously that didn't happen, but the strength was already there. It wasn't any kind of compromise in cash flow. It was more of kind of a positioning of our company and what our concentration was on for when that happened. And it's certainly been true to that throughout this year. So, really specific to what we do is the sale leaseback. So this is a really interesting part of the transactions we do. I really enjoy these. I think we like having this niche and operating in this space. So a sale leaseback is when we're acquiring a property from a seller who currently occupies the property and simultaneously leasing it back to them. Usually, like I said, a long-term lease, 15, 20-year lease rate. So the play is really to, we do the sale leaseback and we have a fresh lease in place that we're able to build some goodies into that lease, which I'll get to. And you have a long, runway ahead of you. So if we're holding a property for an average of, let's just say 5 years, we still have 10 to 15 years left on that lease when we do exit. And so there's a lot of value in that property still. It's a really stabilized, very predictable rent and income for a buyer when we go to sell. So people often ask who is your buyer when you exit? Who's buying these properties, right? These are just high net worth individuals or what? And it's usually not that, actually. It happens sometimes. Someone who wants to 1031 out of a property, exchange into something a little larger. But these properties are pretty big in size and usually fit a REIT or institutional fund really well. They get that very predictable cash flowing property. So when you have this triple net lease, there have virtually no expenses. So that kind of is a big part of what we do and why we like this model. So you're coming in with the sale leaseback and have instant occupancy at 100%, right? The tenant is a single tenant, they occupy the entire space. And with a triple net lease, we're not looking at any expenses, as the tenant's responsible for maintenance, repairs, insurance, taxes, everything. A lot of times it's kind of get thrown around a little bit. Absolute net lease or triple net lease or net leases usually mean the same thing, but basically no responsibilities for the landlord. So having that built-in tenant is very nice. A big part of why we like these sale leasebacks is, there's that 100% occupancy, so cash flow is coming from day one. So for us and our investors as well, everyone gets to experience that cash flow immediately versus a different type of play. I see a lot of value add plays where, the risk is really more time. It's, hey, we're going to get cash flow out of this property, but we need to put some capital into improvements. And it may be 1 year, maybe 2 years, maybe 3 or 4 before we really start seeing stabilized cash flow. So this is why we're a big fan of this model. We like that instant cash flow. And before I joined MAG Capital Partners, I was just a passive investor. I mean, this is what drew me to this company as well. I just said, this is great. I want something that cash flows instantly and very predictably. So I'm going to jump to the next slide here. So the big question I get when I'm talking to new, did you have something to add, Neil?
Yeah, quick question. So the companies that are participating in this, is the only reason they're doing a sale leaseback is cash? Are they just looking to utilize the cash for something else, whether it's operations or expansion, or I guess what's the cause for the other side?
It's like you can see my next slide. Yeah, I wanted to go into that because exactly what you're asking is a huge question we get, right? People say, hey, this sounds like possibly a move of desperation, right? You have a company who's selling their property. Why would they do that, right? And we're kind of, conditioned to think like residential homeowners, I think, where we say, hey, this is better for you in the long run. You're paying down principal on the loan of your home. But, we're talking about commercial real estate with these companies who they're looking at the proceeds from the sale leaseback as a way to grow their business. So, Neil, I'm going to throw this slide to you and you could talk a little bit about motivations for sale leasebacks and why sellers do these.
Yeah, absolutely. And, you can see the points on the screen here, but really it's important to view sale leasebacks as an alternative form of financing for these corporations. So they have a number of tools at their disposal. They can get lines of credit, they can get corporate debt, typically long-term corporate debt, or they can, cut expenses. These are all ways they can basically free up cash flow to, reinvest in other parts of their business. So this really is one way that they can essentially free up cash without utilizing those other avenues. And often, really, I think the best way to visualize this is in the form of an example. So the majority of our deal flow comes from private equity-backed operational companies. So typically, imagine you have a company, it's in Nebraska, they make, we'll say corn widgets, right? And so this company's been making corn widgets for 50, 60 years. Typically, it was founded by its owner. He founded it in the 60s, been growing this thing. The company has a lot of money. He's looking for an exit. He's getting kind of old. He might stay on for a year or two, but he's looking for kind of his cash out. So he will go and he'll sell to a private equity group. And that PE group will come, they'll look at these corn widgets and say, hey, you got a great model here. You've been consistently profitable. We think we can really optimize the operations of this company in a way that we think we can expand your revenues and hit new markets in a way that you couldn't under your old leadership. And so they'll come in and they'll buy it. And at that point, the corn widgets company often owns its own real estate. And then that PE group who now backs them, they'll come to us and go, hey, we just bought this new company, came with the real estate. We're looking to sale leaseback that real estate. And at this point, that's their motivation. They're looking to free up the capital tied up in the real estate, and they're going to reinvest that into the operations, which is what they have a strategic advantage in. So usually it's a combination of paying down corporate debt. So they're looking to deleverage a little bit. They're also looking to sometimes reinvest in capital improvements, maybe a new manufacturing line, maybe some additional square footage, some combination of that. And they'll come to us. And then at that point, we start really negotiations. And that negotiations, it's a little bit more of an art form for a sale leaseback, because you're not just negotiating the price of the building. You are negotiating two things. One, the price of the building. But the second piece, simultaneously, you're negotiating the terms of a brand new lease. So this could be, they might come to us and go, hey, we're looking for a really low price per square foot rent. And we say, okay, we'll engineer a sale leaseback where you sell it to us relatively cheap, and then we rent it back to you for below market rents. Or maybe they say, hey, we want to maximize proceeds. And we say, okay, we'll buy it off you, maybe at or even slightly above market. And we're going to turn around and lease it back to you at a, probably higher than market lease rate. And so those are kind of the two extreme scenarios. And often if we have the choice on those, we usually err toward, buying it below market and leasing it back to them below market, because that gives us the option, if they were to go dark while we held them, that would give us the option to release the building at the same rental rates more easily and still hit our pro forma projections.
Yeah, there's some possibility for value add there even. You have a ton of downside risk if you have below market lease rates, but, potentially you could bring someone in for, market lease rates and actually add value to the property there. So we like that. It's really protects us from that downside risk, but it also creates a tenant who doesn't really have much incentive to break their lease, right? I have a great deal here. Why would I want to move? I have really predictable low overhead costs, relative to the market. And so as long as we can negotiate that on the sale price, then it's, it's certainly doable and it makes sense for us as a sponsor. Well, I'll jump down here. We do a lot to mitigate risk because if you think about what we're doing, it's a single tenant. That's where all the risk is. We have 100% occupancy. However, it's just a different risk profile with a single occupant. So we do a ton of due diligence on the front end with tenants who are in place, or I should say sellers who will be our tenant for a long term. So, we want to see how strong they are financially and really just understand them and start to think like a private equity firm a little bit, really understanding who they are, what their financial structure is, because, these are typically what you'd call a sub-investment grade companies, right? So these are generally less than $100 million in revenue per year companies, mid-sized type of companies, sometimes larger than that as well. But, these companies don't have credit rated by Moody's and other financial firms like that. So when you have these private companies that are, you know, sub investment grade, there's kind of some risk associated with that, that really perceived risk of who that tenant is and how much risk there is of them defaulting or going bankrupt, right? That's obviously the real risk there that you have to look at. So there's, you know, we have to do a lot of digging in to review their financials and look into, like I said, everything. And that's really where we find that that gap between what that perceived risk is and what that real risk that we see. You know, we get a really good understanding of the risk of each tenant and the property when we go into them, when we go into contract, I should say. So that's really kind of where we find the opportunity. Go ahead.
I was going to add to that slightly. So, and the reason we play in that space, I mean, that is our really comfortable swimming hole right there, is that 7 investment grade. And these are still companies that are turning, you know, 60, 80, 90 million dollars a year in revenues. So they're certainly not small companies by any means. But the reason we play there, I mean, you can buy a real estate tenant and buy a Walgreens, you know, a Home Depot, an Amazon warehouse center. And certainly, you know, these are credit rated tenants and you have an extremely low risk of default. But the flip side of that is you're only going to be able to tie up these properties at like a 3 cap, maybe a 4 cap. You know, the cash flow is going to be, you know, maybe 2 to 3% a year. And, you know, that's the trade-off there. So, you know, for us, the reason we're able to structure these properties at, you know, 8, 9, 10% a year distributions, and then a decent profit split on the end, is because we're playing in that sub-investment grade space. And really that arbitrage between actual risk and perceived risk is what creates value. And that, you know, being able to understand that perceived risk versus actual and being able to wrap our head around it, being able to articulate that in the form of, you know, a very concise and clear credit memo. I mean, that is ultimately, you know, how we're able to pursue, you know, above market returns in this space, because we're able to take on some additional perceived risk in that area.
So how we mitigate that, we built, like I said, we built some goodies into the lease, and these, I call them goodies, but really they're institutional features. You know, we're studying what some really institutional companies, like some large REITs, are doing, how they're structuring their leases. So, you know, we're trying to mitigate the greats and see what they're doing. And we found some tools that really help us not only mitigate the risk here, but really helps sell the property when it becomes time, because these are non-starters for a lot of these institutions. So quarterly reporting, quarterly and annual audited reporting from the tenants is required in those leases. So we want to see all their finances. You know, I don't know how many real estate companies and teams have a team of credit analysts on their team, but you know, this is sort of how we operate with a single tenant on a net lease, right? So we have a team of guys who are not only looking at new opportunities, but existing tenants, and reviewing their financials and, you know, seeing if there's blood in the water, if there's problems. You know, maybe we can partner with them and help them out if they just need to get over the hump. I mean, we certainly did that recently with the one tenants at the beginning of COVID when they were shut down temporarily. So yeah, that was a little more obvious, but if we there could be a couple quarters of declining revenues, and you know, we can just call them up and we're on a first name basis with their C-suite and find out what's happening and what we can do to help. We talked a little bit about institutional investment structure, but really the due diligence, and you know, it's all the front end due diligence that's where a lot of the work is. You know, these are very these aren't super complex once they're under management. You know, there's no expenses coming in. There's on this net lease, single tenant. However, there's a lot we look at on the front end to look at these tenants. Some people ask me, they say, hey, what's your criteria for a property that you look to acquire? So, you know, obviously we look at their financials like we talked about, but it might be a corporation that has a dozen different locations. So what we're looking at is that unit level profitability. So we want to see if, you know, at that single property, how important is this property to the company as a whole? If this is a very profitable, very important part of the company, then should there be some kind of, Chapter 11, at a, very bad situation, or just a, kind of a, withdrawal of the market and revenues, this is going to be an important property to the company. This wouldn't be one of their dozen properties, let's say, that they would decide to shed should that happen. Another line of defense is just looking at that overall credit. Many times in that situation where we talk about multiple locations, all tenanted by the same company, can we get a corporate guarantee from the, the holding company that owns this brand, or at least owns the entire company, including this, that operates out of this single property that we may be purchasing. And then, of course, I talk a lot about the tenants, but really it does come down to fundamentals of the property. We want to look at what that basis is of a property. And if we're coming in at something close to the dark value of that property, meaning no tenant in place, what is this property worth without a tenant in it? That's where we want to be, and we want to be able to fall back on that should we run into a situation where we may need to exit a property. That's extremely unlikely, but it's certainly, we have to look at that, the fundamentals of what the demand is there, what are the vacancy rates in the market, is the market growing, and really look specifically at the industrial space, right? Because sometimes you can find a slightly more tertiary market, but it's a big manufacturing city or whatever it might be.
Yeah, and to add two things to that, and thank you for that, Drew. One is to talk about the tenant credit. So we have a number of ways that we can do what's called credit enhancement. So if let's say you have a company where they've had historically strong revenues year to year, but maybe COVID hit them a little harder. We can require, for example, a longer security deposit. In some cases, we've actually had them pay a full year's worth of rent up front. We can hold a much higher security deposit, maybe 6 months worth, as an additional credit enhancement piece, and say, hey, once your revenues return back to pre-COVID levels, we'll release this. Another way we approach it, this is even before COVID. If let's say a company is profitable but maybe a little smaller, so maybe they're only turning, say, $15 to $20 million a year in revenue for whatever they're making, we might require a secondary guarantee from the owner if the owner has high net worth. So that says, hey, even in the event that this company goes and files Chapter 11, we could theoretically pursue the individual who owns that business for ultimately the terms of the lease there. So those are tools that we have in our disposal to basically bolster the credit worthiness of the overall structure for these deals.
Yeah, it kind of shows you how creative you could be in the acquisitions. Is what does the credit look like of the tenant, and how big are they? What secondary safety nets can we build in? So it's a little bit case by case. It feels like a lot of the deals we do are very similar, but there's always different elements to that. Mitigating the risk that we can employ. So we're wanted to kind of wrap it up here, so we had plenty of time for Q&As. But as far as the future, I get asked this a fair amount as well. What's happening in the space? Sale leasebacks, is that something you see happening continuously in the future? Are you going to find more opportunities? And yeah, there's no signs of letting up there. There's a lot of mergers and acquisitions out there. Private equity companies are just as active as ever, if not more, in consolidating some smaller companies, and of course pulling the equity out of these properties that are trapped there so they can continue to grow them. So as long as we can keep working with these guys and finding these opportunities, we're going to. And really we're getting a lot more momentum as we work with more private equity firms doing these sale leasebacks. They look at us as a reliable partner in these transactions. So it's nice to build a little bit of momentum there and have that relationship with a lot of these companies who are spurring these kinds of transactions. I don't know if you have any thoughts to add to that, Neil, as far as what you're seeing and hearing from brokers and the supply of opportunities out there.
Yeah, I would say the biggest trend we've seen in the last maybe 3 to 4 months is there's been a lot more money in the markets in general. So more capital chasing fewer deals. That has increased the competition. However, a mitigating factor of that is we found that more and more business owners have opened themselves up to the idea of sale leaseback. So the whole kind of financing structure of a sale leaseback is becoming more mainstream, which is opening up opportunities. So those two factors may be canceling each other out a little bit, but we're still seeing a lot of opportunities, and there's other parties out there that we compete with, but we're still having the opportunity to win deals.
So I'll throw up a little bit of our track record here. We have, I believe we're at 24 properties under management right now. So as you can see, we focus pretty heavily in Texas and the Midwest. We have some properties in California too. Opportunities in industrial. I mean, we just see a lot more opportunities in the Midwest and Texas. There are more manufacturing, more warehousing and industrial out there. But anywhere we have growing markets, there is going to be supporting need for more industrial properties. And what's kind of interesting is retail is sort of coming back depending on the region. I'm out here in California and they're sort of shutting things back down, but there's other areas where they've opened up more. And as those retail kind of comes back stronger, there is even more need, of course, for the infrastructure that supports that, which is a lot of industrial assets and the logistics firms that operate in that space too. So I won't, I'll let you take a look at this in your own time. If Jim and Sean want to share this later, I sent them a copy of this deck. But, we're pretty proud of not just having assets under management, but having gone full cycle in a fair amount of properties as well. So, like Jim, you were saying earlier about you're in a plane, we're going to figure out how to land it. There's plenty of good sponsors. However, I would say, look, if a sponsor hasn't gone full cycle on a deal, their projection on annualized returns is really just that, right? It's a projection. So, I really point to this pretty heavily and say, hey, we don't underwrite these deals, with a dartboard, of course. We're really looking at them conservatively because we want to hit that annualized target for our investors. So there's about 13 deals here that we've gone full cycle with. And I know we have about 4 or 5 of them current assets under management that are in contract to sell right now. So we could be adding to this, and I'm excited to do that and kind of bring more capital and profits back to investors. And a happy investor will invest in a new opportunity, right? So if you have questions about this later, feel free to reach out. But that's I'll kind of wrap it up there, leave it here with some of our contact information. Here's Neil and I on the capital markets team, and of course the principals as well. We're based in Texas, but Neil and I are both in California, and as well as Andrew G., who is also in the Bay Area as well. So Jim, do you want to open it up to questions? I can leave the screen up if you'd like for now.
Yeah, absolutely. If you have questions, go ahead and just go ahead and chime in, unmute and chime in.
Yeah, I've got a question for you guys. What's your take on how office space is going to look after COVID? With a lot of the whole remote working and that kind of a thing. What's your take on kind of that space going forward?
Neil, you want me to take that, or you want to talk about it?
I have a skewed view living in San Francisco, where the office towers look like a doomsday scene. But that's kind of a result, in my opinion, of a tech heavy metro there. But Drew, yeah, go ahead.
Well, I think it depends, right? You have some flex office space, and then you have some single tenant office space, right? And you're going to have some single tenant offices that I think are going to hold onto them. There are already probably many that are on some long-term leases already. We've done some properties with office. We did a sale leaseback in a building in Omaha, Nebraska that was tenanted by Scantron, the testing company. And it's about 2/3 office space actually, but about 1/3 industrial to keep a lot of their supplies and things like that. So, you know, when we pushed that opportunity out there, the first thing some people said was, hey, this is office space and this is a little scary. Why would I invest in this space? And, you know, frankly, it was like I said, office and industrial mix, but we had a single tenant who had a lot of stability, continued revenues in their technology space as they're doing a lot of testing online. So once again, we're looking at the tenant and we really have to look at them case by case, but you know, we're not going to jump into the 100% office pool anytime soon. So that, you know, I personally don't know that I would invest in office unless it was really, you know, unless the basis was really low. I mean, you might be finding some distressed properties and be looking at a long-term opportunity. So if someone's out there finding those opportunities, but you know, I think it's a little bit case by case by region, tenant type, and how many tenants are in the space. So hopefully.
Yeah, and one thing to piggyback on that, I think when people think office, they often think these big Class A skyscraper type of office spaces in big cities, and those I think really will take longer to recover just because they were on the expensive end of the market. And you know, if a company's looking to cut costs, that makes a lot of sense. But so much, again, you know, you got to look at, hey, who's tenanting the space and how critical is this area for their operations? And you know, quite often it's really they chose those locations because it's strategic, it's the right size for their employee pool, it's close to the manufacturing. Oftentimes it's actually part of the same, you know, warehouse or manufacturing or whatever it is they do. So in those scenarios, I think office is much more sticky. And I think those, you know, type of deal structures will likely, you know, be much more resilient in the near term than, you know, say the, you know, the Class A upper end of the market office.
Really quick, I'll just add, we have, you know, weekly meetings where we're looking at new opportunities, and you know, a couple full office buildings came up, and we all just said hard pass and moved on. So it's where that's not really our space and not something we'd be interested in right now. So
Great, thanks, guys.
Question.
Drew, do you want to talk about pipeline? We can keep it quick, but you know, maybe you can mention Huron, which got the LOI got accepted today, and possibly Fence Creek.
Yeah, excellent. Yeah, we do 8 to 10 investments a year. So you know, sometimes they come in batches, and we have a couple sellers that we've been talking to for a bit with looking for a hard 2020 close. You know, for whatever reason, they need to close by 2020, but a couple opportunities coming around the corner. You know, this is a private investment group, and you know, we can kind of talk about that here because of that. But you know, we're just getting into contract on a couple properties. I'd say 99% sure we're going to go into contract unless something blows up on these. But you know, here's an example of what's coming around the corner. If you'd like to reach out to us and join our investor network, and that you can just email me directly. My email's here. If you'd like to set up a call and get on our distribution list, we can do that. But we have we're just getting into contract with the property. It's about an hour north of Detroit. It's in Lexington, Michigan. It's about 200,000 square feet of industrial property, some office mixed in there as well. And the tenant is a company called Huron, and they are part of a larger holding corporation called HDT Automotive. They have 10 locations worldwide, but this is their only North American location, and they manufacture complex tubular assemblies and some precision machining, machined parts, I should say, for the automotive industry. I think they have some defense work they do as well, but mostly automotive applications. So they're supplying to factories all over North America. So great tenant. They've been around since 1943. So we love a tenant that's been around for a long time and has about a 14% EBITDA margins. So these are, you know, we talked about what we look at. This is stuff we look at: a really strong, long-time tenant, great revenues and margins. But that property is probably, it sounds like we're going to be going into contract any day now. And when that happens, we're going to be pushing that out to our investor group to see who would like to participate and deploy funds into it. The underwriting's not totally done, so I don't want to put my foot in my mouth and say, put returns out there. But usually we won't start with a preferred cash distribution of less than 8%. That's usually a starting point for us, and it can go above that. But over time, as the rents increase in the lease, we increase that preferred return over the years as well to pass that along to investors. There's another really short 3-property portfolio in Texas. Fairly small deal. This one will fill up very quickly, but it's tenanted by a company that makes precast and prefabricated wall and fencing systems. So another one we're excited about. I think these are kind of going to be the last 2 of this year. Neil, any further thoughts on those?
No, I think those will definitely be the last 2 of this year, although next year is looking to have a pretty healthy, deal flow funnel from what we're seeing so far. So, but yeah, I don't know if Drew, if you talked about the logistics, or if you want to handle it on a different call, and just in terms of, how to make sure you can see these opportunities, and then, if you are interested, how to take place.
Yeah, sure. Like I said, just reach out to me. We need to kind of have a connection with someone just to get to know who they are, or at least some sort of referral. I know this is a private investment group, so we're basically there already, but like Jim and Sean, we've talked for a long time, and they're on our distribution list. So we send all of our investment opportunities to them, as well as all of our other investors, and they're able to take a look at it and really ask questions if they'd like. We usually host a couple webinars, which are really great because you get to hear from the 2 principals and ask questions about the deal on an individual basis. But when we send these out, they can fill up really quickly. This is not a pressure tactic. I'm just trying to be realistic here. We had our 2 recent acquisitions. We had $4 million in equity, and each of them filled in about 3 or 4 days. So I always tell people, take a look at it. And if it's something you think you're reasonably interested in investing in, just let us know you'd like to make a soft commitment. And if you decide to pull out because of whatever reason, no hard feelings, is no problem. But I just want to make sure if it's something you're interested in investing, that you don't miss that opportunity, so we can set aside those funds for you at least.
Drew, can I ask a question?
Sure.
I'm a big fan of the tenant reporting that it looks like you do. Can you speak to, do all the investors have visibility to that, or is that something that siphons through your group and then you report? How does that work? Because I think it's a fabulous idea.
So when we close an investment property, we do quarterly reporting to our investors. These can be really boring, but we do have a lot more information that's available upon request. So, many times it's, hey, our tenant continues to operate and our investment is continuing to hit expectations. So, here's your cash distribution. Have a nice day. We'll talk to you again another quarter. This is what we want. It's a passive investment. However, we are, of course, looking at and reviewing those financials. So if you as an investor are interested, by all means, we'll share that. Sometimes the tenants can be a little bit sensitive about widely distributing their financials, but it's not a problem if you want to take a look at it.
No, that's great. And do all of the properties go through the same workflow there, like when they turn in their quarterly reports?
Yeah. We pretty much require that on every single property. We want to see that, and they understand the risk profile of the investment and why we would want that. And we're asking for all of their financials even before we close on the property. So we're certainly not strangers to their business and their books already. And we share all of that, of course, with investors before they decide to invest as well. So our credit advisory team puts together a really nice credit memo where they talk about everything from, they show graphs and charts, and they do what the financial guys do, but really point out, hey, here's where we see some strengths, and here's where we may see some risks too. So it's a really nice memo, and I love that we can give that to our investors.
Great, thank you.
You talk about the about depreciation. I know a lot of us invest in these things because of the tax benefits from commercial real estate syndications. So can you talk a little bit about the tax benefits and depreciation?
Neil, I'm going to let you talk about our cost seg studies.
Yeah, certainly. So commercial real estate, anything outside of multifamily or residential, the IRS depreciates it on a 39-year linear depreciation schedule. What we do, obviously, we're not holding at 39 years. So we're actually able to use an IRS strategy called cost seg studies. What that means is we pay, about $1,500. This group comes in, they look at the HVAC, the roof, the equipment, and they say, hey, this building's actually depreciating at a faster rate. And we basically take that, submit it to the IRS, and we're able to take what's called accelerated depreciation. And without getting into the weeds too much, it's more than what the standard rate is. And typically for the first, I would say, I'm generalizing here, but for the first 2 to 3 years, most of our projects actually have negative K1s, meaning the depreciation actually exceeds the distributions that go out. And again, that's a benefit from a tax level. So you typically will have carryover depreciated losses that you can use to offset other passive income from other investments. So, and even after that, typically the taxable liability is very, very low. So for the most part, during the hold period, you're paying little to no taxes on those distributions that come out. And then when we sell, any profits realized in that profit split, those are treated as capital gains, so a lower rate than ordinary income.
I have a question. Who do you normally sell to and why? Because I was looking at the hold periods. They seem relatively low compared to multifamily.
Sure. Yeah, there's a lot of institutions. It's really REITs. It can be endowments, any other kind of funds that are out there. I mean, this is a very nice addition. Like I said, a stabilized cash flowing property that's net leased. So these really make sense for these institutions. They don't have to put their hands on a lot of the moving parts of the day-to-day operations and expenses that are there. So that's usually what we're seeing. And some of these institutions are so big, they say, well, one property is great, but that's honestly not even worth our time. Can we take 4 properties as a portfolio and purchase them all together? So it's like that's not exactly what's happening right now. There are different buyers, but that has happened where they say, hey, we're looking at a sizable acquisition here. I don't want to waste my time with a $10 million property. I need to add a lot to our portfolio, and these meet the criteria that we have for whatever fund it might be that they're adding properties to.
Hi, Drew. It seems like when you do the sale leaseback, that's at that point when you're negotiating it, that's the primary time where you're kind of setting your expectations of what your return is going to be. How about in between, after that period, is there things that you can do to kind of juice your returns after that?
Let me take this.
Yeah, go ahead.
So really, I mean, there's 2 components to the value we're creating here. One is the distributions, and that's basically, we're just paying back a return on equity there during the hold period. And then on the back end, a lot of times people say, hey, if this is, kind of a set rate lease, not a lot of moving parts, they're envisioning maybe more of a multifamily value add scenario where you're doing a bunch of rehab. So we're building value kind of in 3 ways. The first is principal pay down. So we do fixed rate debt. So every month we're paying down the principal owed. So we're building equity in the project there. The second is because of the net lease structure, with our leases, they come in and our leases have built in 2% rent bumps. So this is the main way we build value in a really predictable fashion. So because there's no expenses, 2% increase in rent every year equates to 2% increase in the NOI every year. And so as a lot of you are probably familiar with, the final valuation of a property is that cap rate, the function of cap rate and NOI. So if the NOI is increasing, that final valuation is increasing as well. And then the third way is a little less consistent, but we've been really fortunate in the past for choosing wisely. And that's an overall credit enhancement. So that it can take place in a lot of ways. Either the metro improves, let's say we buy just outside of Austin, 5 years from now when we sell, now it's part of, what's considered the Austin Metro. And that scenario, that area is going to have cap rate compression, and we're going to be able to see a better price. Or let's say the Metro stays consistent. What we've seen several times and actually realized on some of our exits, we've bought real estate tenanted by companies who are just being bought by private equity. And then 4 or 5 years down the road, when we go to sell, that private equity group has, say, doubled the revenues of that company. And now we have a much stronger credit tenant in that building. And now we're able to sell at a lower cap rate down the road, all other things being equal. So those are ways we create value. And those are ways that we're able to, oftentimes exceed the projections, and we try to communicate those changes throughout our quarterly reporting to our investors.
Thanks.
Yeah, and I'll add to that, we're conservatively underwriting these. So, if the market's trading at a 7 cap, let's say, and you'll see our underwriting, if you're looking at an opportunity, we show, 10-year pro forma, and we're not assuming any of these cap rate compressions. That's a nice thing that can happen. And, but, we want to be very conservative with our assumptions. So generally we're looking at it can be a static cap rate across 10 years, and whatever year we sold, we're still going to see that value creation, like Neil was saying, of the NOI increasing and the pay down of the principal of the loan from the banks.
So just to throw a little wrench in the works, what's the worst investment you guys ever made?
We've done pretty well. I'm gonna go back to a slide of our full cycle returns. But I'd say the worst one here, actually, I think it's the only one where we've missed our projected returns, was that Fort Worth office investments. And Neil, I don't know if you want to talk about that one, what happened and why that didn't hit. It's kind of, Andrew loves to tell the story, but I don't know.
Yeah. I'm kind of laughing because our worst investment, we delivered 18% to our investors, but we as a sponsor group lost money. So that was our worst investment from a sponsor side. And that was, we had basically a guaranteed fixed rate return to our investors. We didn't lose a lot. It was just slightly below break even. But in that other scenario there, it was that you're talking about the Folk Street property, Drew?
Right.
Yeah, and on that one, it was a function of exit scenario that didn't quite happen. So we held it for roughly 4 to 5 years, the same as the pro forma, paid out all distributions on time. But when it came to sell, I believe it was a function of, this was before I joined the company, but I believe it was a function of the type of debt that we had on the property that had a much higher prepayment penalty than what was originally expected. And so all things being equal, the prepayment penalty ended up, essentially working down some of the proceeds in a way that lowered the returns from 17% projected, and we delivered 15. So a narrow miss, but ultimately it was a learning lesson. And since then, we actually will typically take slightly higher rate debt that allows us to be more flexible now. So for example, CMBS rate or CMBS debt right now in today's environment is typically, you're able to get about 3.5% interest rate. And instead we will skip that and actually take personal guaranteed debt. So the principals, Dax and Andrew, will sign personal guarantees. And we're able to get more flexible debt that allows us to, even if it's say a 10-year term, allows us to sell, at year 4 or year 5 without any sort of prepayment, without any sort of, debt swap yields, or really a lot of these ways that banks, try to get the desired revenue on a 10-year hold, even if you sell early. So those are things that can kind of bite you in the butt. And really we've learned as a sponsor group and how to mitigate that.
Anybody have anything else? We've gone over our hour, which is great. I think everybody's found this very useful, but I want to be cognizant of Drew and Neil's time, especially since Neil is on vacation and Drew is getting ready to wind down his West Coast work day. So if that's all we got, we'll let you guys off the hook. But I just wanted to say, Drew, Jim opened up by expressing one of the tenets of our group, and that's to be a community of like-minded individuals and to educate one another. And another one of those is to invest with folks that we know, like, and trust. And the first step in that for all of us is to have conversations with different sponsors. And for those of you that have worked with our deal and or sponsor worksheet, you know that we have a plethora of questions that we go through recommended when you're talking with a sponsor. And Drew in our call was so giving of his time and patient and working through all the questions that I know others have had in those conversations. So he is definitely, if you've liked what you've heard here on sale leasebacks, these guys are definitely worth giving a shout to. I've been very pleased with the MAG deals I'm in. I look forward to getting into some more of them in 2021. And again, Drew and Neil, thanks so much for your time this evening. This was very helpful.
Sure.
Absolutely. And thank you for having us.
Thanks, guys.
Pleasure.
We really appreciate it.
We'll peel off. Oh, go ahead.
I was just going to say, you're welcome to hang on or sign off. Either one. We're kind of running a little bit late. That is fine. I do want to do a couple of introductions. So, if I was in Hawaii, I'd be off already. Probably if I was in San Francisco too. But you're welcome to stay if you want to hear what we're doing next. So thank you very much. We appreciate your time. Moving on real quick, I want to talk about the next meeting is December 14th. We're usually the fourth Monday of the month, but Christmas. So we're going to be on the 14th, and we're going to have Ian Kurth, who is a passive investor. And he's the guy who's one of my networks, and he just is a really bright guy. And I make this joke all the time that if he says yes to a deal, I don't even look at it. I just go on his coattails because the guy knows his stuff. So it'll be interesting to hear him talk. That's on the 14th. I know every time we have these meetings, I want to stick to an hour, but this is our first one with a bigger group. So I do want to just do a couple of introductions. And my goal here is we're on Zoom, which is great for getting speakers, but it sucks for networking. And so I want to give people an opportunity at least to hear from other people in the group and get an idea of what our group is like. So I was going to do two people who've been around for a while and two new people, but I'm just going to do one of each. And so Chad, I'm going to ask you to go first. Chad Ackerman is, as I said, one of the contributors to our group, and he's done an awesome job. He's also leading another a TribeVest group that is investing together and doing a fantastic job on that. So Chad, if you just take a couple of minutes, I don't want to go too long, but just kind of tell a little bit about your journey, how you got here to passive investing, and like I said, just a couple minutes.
Sure. Thanks, Jim. I don't know if the guys jumped off. Looks like they already jumped off. So thank you for their time. Chad Ackerman, nice to meet the new people that have joined the group here. I'm just one of those people that the switch has flipped here in the last couple years that I've really gotten into the real estate world. I've been at a W-2 job for a career, and that's been fine and great. It's afforded me an opportunity to save up some money, and now I'm finding avenues that excite me a lot more to get involved in this space. That my goal is to be able to get to a point where I'm out of my W-2 job. That might be coming up quicker than I think. I'm notorious for the shiny object syndrome that I think a lot of us have had. Got a blog about it even that we're putting together. But I've tried out a little bit of everything along the way as I've educated myself. And I think actually Jim may have been the one that said to me, well, if you want to take 50 grand and put in a flip of a house, why not take 50 grand and put it in a passive investing gig instead? And you'll still get there in the same space. May take a little bit more time, but you'll get in the same space, especially doing a W-2 job. And that really clicked for me. So I've done a little bit of private lending, but I'm in just getting in my third and fourth syndication right now, as a matter of fact. Mostly multifamily, but I've done some self-storage and precious metals as well. And I've just tried to absorb everything I could from this networking possibility, which has been fantastic. So I'm grateful to be a part of the group and be able to learn alongside of some of the newer people that are aligned like me. from those that are veterans that have been around doing this for a little bit longer, which has been great. So love to reach out, talk to the new people as well. I've tried to make my way around most of our current group too, but happy to network with whoever's interested. I always like talking about real estate, so happy to talk to people.
Awesome. Thanks, Chad. And, you know, one thing, if anybody wants to connect with somebody else, you can always ask me and I'll, you know, share information. But also, until we get a little more fancy and get on MailChimp or something, you can see everyone's email address. So I think that's part, you know, I don't want to hide email addresses because for now, this is a small group and the goal is networking and getting together. So, you know, if you have a problem with that, let me know and we can make arrangements. But for now, you know, please try to connect with each other. That's how we learn. So I would like to get one new person, and Greg Baxter, you are unmuted and close to Chad in my little screen. So if you don't mind getting put on the spot, if you'd give us a couple minutes.
Yeah, sure. Yeah, thanks, Jim, for inviting me out for this. I heard Jim on the Whitney Sewell podcast, which I've been listening to. I've been doing this since about 2012, but like on a very small scale, 5 and 10 grand increments and in a few different early investments. And then I think it took a little while. Maybe I was a slow learner, but about 2018, it really kind of clicked for me. And I'm like, wow, I've kind of seen it come full cycle. And so since then, I've been on a kind of a tear to get into as many of these things as quickly as possible. And, you know, listen to a lot of podcasts and you know, reading up on things and getting out to local meetups and meeting other, you know, syndicators. I met Whitney when he was at a New Jersey event with one of the local guys out there. So yeah, I think I'm in 10 plus at this point. But really over the last, you know, two years, I've, you know, kind of harvesting the equity. I have a couple of rental properties and been really focused on that the last couple of years. But you know, so you know, happy to share, you know, those folks who I've been investing with, and you know, appreciate this. This was interesting too. I've never really knew about all these triple net leases, so I'm kind of curious about this. You know, another shiny object, I guess.
That's right. Cool. Thanks, Greg. So I'm going to leave it at that. But the one thing I think we're going to find as we expand this group is we're going to get some people who haven't done, you know, any deals, and we're going to get some that have done more than 10 like Greg, and it's just adding to the community. And so I know at the beginning we talked about, you know, we're only going to have 12 people, and you know, now we have 30 some, and it's going to keep growing. And I think this is the way to do it. And as I said at the beginning, we flying this plane. I don't know where we're going, and I don't know how we're going to get out of the air, but we'll figure it out together. And I really would like feedback and help from all of you. So if you have ideas for speakers or you have connections to speakers, we don't want to have a syndicator every time. You know, I'd also like to have times when it's just us talking. So maybe we decide we want to do a syndicator roundtable, and we all, you know, a syndicator and talk about them behind their back instead of having them talk to us, just to kind of, you know, see what deals you've invested in. So any ideas you have, please share them with me or with any of the group so we can start, you know, we're going to get together the kind of the leadership team here, and we're going to try to come up with some speakers and some ideas for our meetings for 2021. We have Jeremy. He'll be our February speaker. He's a pretty well-known passive investor. Other than that, we're searching for ideas. So if you know somebody or there's a topic that you're interested in that maybe our network can find somebody that can do that, please reach out. This community is only going to work out if everyone is contributing and being a part of it. So if you have something to say it. We'd love to hear from you. So if no one has any questions or comments, I'll pause for a moment. Okay, our next meeting is December 14th, Ian Kurth, and I will send out the video today as well as the slide deck that Drew had. And that's all I have. Thank you very much. Welcome to all the new people, and thank you for all the old people for showing up, and we'll see you in a few weeks. And happy Thanksgiving.
I do.
Thank you, everybody.
Thanks, guys. Thanks, Jim.
We'll see you.